In the mid-1980s, while thousands of investment funds on Wall Street struggled to make even a 10% annual return, one man quietly achieved something almost unimaginable. Peter Lynch, the manager of Fidelity's Magellan Fund, delivered an average return of more than 29% per year for 13 consecutive years, turning a $1,000 investment into nearly $28,000. No magic formulas, no insider secrets, no supercomputer algorithms. He simply paid attention to what others overlooked. The stores you visit every day, the brands your kids are obsessed with, or the companies people in your neighborhood can't stop talking about. Peter Lynch believed that ordinary people, if they truly observe the world around them, can outperform the professionals on Wall Street. And his book, One Up on Wall Street, is the roadmap to doing exactly that, to understanding why the best investment opportunities aren't hidden on Wall Street, but right in your everyday life. In this video, we'll explore the 6 timeless investing principles of Peter Lynch, ideas that have helped millions of American investors rethink the way they see money, the market, and themselves. If you want to learn how to invest smarter, be more patient, and build lasting wealth over time, hit that like button and subscribe so you don't miss the journey through more classic financial wisdom like this. Part 1. Anyone can find investment opportunities around them. Peter Lynch never believed that only people in suits on Wall Street understood investing. On the contrary, he believed that ordinary people, if they paid attention, could see what the entire market overlooked. In 1977, Lynch went shopping at a local mall with his wife and teenage daughter. While he was mentally reviewing a list of stocks, his daughter pointed to a clothing store and said, "Dad, my friends and I all shop here. It's always packed." That store was The Limited. Lynch looked around. Long lines of customers, busy cash registers, and most importantly, enthusiastic, loyal young buyers. Instead of dismissing it, like most investors would, he got curious. He read the company's financial reports, talked to store employees, and realized it was a rapidly growing business. When he invested in The Limited, its stock price went up more than 10-fold. From that experience, Lynch distilled a simple but powerful philosophy. You don't need to be a genius to spot a great investment. You just need to open your eyes. You don't have to be brilliant to find investment opportunities. You just have to observe the world around you. He called it invest in what you know. Invest in what you understand, what you see, and what you believe in. A homemaker might notice which food brand is taking over the grocery shelves faster than any Wall Street analyst. A father might see his kids going crazy over a new toy before the big funds even start writing reports about it. A tech worker might spot the next popular software trend before it ever makes it to CNBC. We, the people living in the real world, hold the most vivid real-time data long before the market catches on. And Lynch proved it with numbers. During his 13 years managing the Magellan Fund, he delivered an average annual return of over 29%, turning a $1,000 investment into more than $28,000, simply by observing what others ignored. Once you realize that every great investment starts from something ordinary, you begin to see the world differently. Every crowded coffee shop, every brand trending on social media, every product that genuinely excites you could be the seed of an extraordinary investment. For Peter Lynch, investing wasn't a contest for the smartest minds, it was a journey for those who could see, feel, and believe in what they truly understood best. Part 2. Understand the business. Don't invest based on rumors. Peter Lynch once said, "Behind every stock is a company. Find out what it's doing." Behind every stock, there's a real business. Learn what it actually does. He believed that the biggest mistake investors make is putting their money into something they don't understand. They buy because a friend mentioned it, because the price is going up, or because they saw a catchy headline on CNBC, not because they understand the company's real value. Lynch once told a story about a friend who proudly said, "Peter, I just bought shares of this company called XYZ. Everyone says it's about to go to the moon." Lynch asked, "What does the company do?" His friend paused for a few seconds and replied, "Something in technology, I think?" Lynch laughed and said, "If you can't describe the company in 2 simple sentences, you shouldn't own it." That became one of his golden rules. If you don't understand the business, you can't understand the stock. And if you don't understand the stock, you're gambling, not investing. Remember this, a stock isn't just a blinking number on your screen. It's a piece of ownership in a real company, with products, customers, employees, and leadership. Lynch said you should invest as if you were buying the entire business. So, before you invest, ask yourself, how does it actually make money? What gives it a competitive advantage? Who are its loyal customers? And most importantly, do you believe in its future? Lynch often called this the scuttlebutt method, the on-the-ground research approach. He would visit stores, talk to employees, chat with customers, and observe what was really happening. No complex data models, just curiosity and time to understand the business from the ground up. A classic example was his investment in La Quinta Inns, a mid-range hotel chain. Instead of relying solely on financial statements, he went there himself, talked to managers, toured the rooms, and spoke with guests. He saw full bookings, efficient operations, reasonable prices, and a scalable model. That's when he knew he'd found a solid business worth investing in. The result? The stock multiplied several times, simply because he trusted his own eyes over market rumors. The financial markets are noisy, full of headlines, predictions, and sure win and grice from every direction. But Lynch believed that true understanding is the only filter that keeps you from getting swept away. When you deeply understand a company, you don't panic when its stock drops. You stay patient because you know you own something real, not a bubble. Investing isn't about who knows more rumors. It's about who understands better. And in a world where everyone chases the next hot tip, the one who truly understands their business is the one who's truly free. Part 3. The 6 types of stocks and how to identify them. Peter Lynch once said, "There's no such thing as a good or bad stock, only stocks that are right or wrong for you." He realized that most investors don't fail because they pick the wrong company. They fail because they don't understand what kind of stock they actually own. To help people escape that confusion, Lynch divided stocks into 6 main categories, each with its own personality, like 6 different types of people at an investing party. And to succeed, you have to know who you're talking to. 1. Slow growers. These are the big, mature companies, the wise old men of the market. They no longer grow fast, but they still generate steady profits and pay generous dividends. Think of Coca-Cola, Johnson & Johnson, or Procter & Gamble. They won't make you rich overnight, but they'll let you sleep well during financial storms. Lynch invested in this group not to strike gold, but to protect his portfolio from volatility. 2. Stalwarts. These are large, stable companies with moderate growth and consistent earnings, like Pepsi, McDonald's, or IBM in its prime. He called them the workhorses of the stock market, not flashy, but reliable and strong. If you buy them during times of panic, when everyone else is fearful, even a small recovery can bring solid returns. 3. Fast growers. Lynch's personal favorite. These are smaller companies growing rapidly, often with a breakthrough product or an innovative business model. Think of Starbucks, Home Depot, or Tesla in their early years, little known yet growing revenues by 30 to 40% annually. But Lynch warned, don't just look at growth, look at whether it's sustainable. A company can grow fast for a few years, but without a true competitive edge, that bright light may fade just as quickly as fireworks. 4. Cyclicals. This is the group that confuses new investors the most. They rise when the economy is booming and fall sharply when the cycle turns down. Think of airlines, automakers, or steel companies like Ford, Delta Airlines, or Caterpillar. If you don't understand the industry's cycle, you'll end up buying at the top and selling at the bottom. Lynch often said, investing in cyclicals without understanding the cycle is like skydiving without looking down. 5. Turnarounds. These are companies that have fallen on hard times, sometimes even close to bankruptcy, but are rebuilding for a comeback. They're like wounded soldiers who might rise again. If they recover, the payoff can be 3, 5, or even 10 times your investment. But if they don't, you lose it all. Lynch invested in this group very carefully, only when he saw real evidence of change, not vague promises in the news. 6. Asset plays. These are the hidden gems, companies whose true value lies beneath the surface. They might own undervalued real estate, unrecognized oil reserves, or undisclosed investments. Lynch made big profits from companies whose stock prices reflected only the visible tip of the iceberg. But to find them, you need the eyes of a financial detective, someone who reads between the lines of annual reports. For Lynch, understanding these 6 types of stocks means understanding the essence of investing itself. Because wise investors don't buy everything, they choose the right battlefield. You can't expect the explosive returns of a fast grower and still sleep peacefully like you would with a slow grower. You can't buy a cyclical stock without bracing yourself for a fall. When you know exactly what type of stock you own, you stop being afraid of market swings. Because instead of asking, why is the price dropping, you calmly ask, has the company's real value changed? And that's the moment you stop being a market player and become a true investor.
Part 4. Don't try to predict the market. Focus on the business. Peter Lynch once joked, if you spend 13 minutes a year trying to predict the market, you've wasted 10 minutes. He wasn't just being funny. It was the hard truth learned by millions of investors on Wall Street, people obsessed with guessing the perfect time to buy or sell, while forgetting the only thing that actually creates real wealth, the business behind the stock. Imagine walking into a giant supermarket called the stock market. Everywhere you turn, people are shouting, the price is going up, the price is crashing, the S&P is doomed, AI will change everything. All that noise makes you forget that behind every ticker symbol, there are real people running real companies, producing, selling, innovating, expanding, and creating genuine value. Lynch was asked hundreds of times, what do you think the market will do next year? His answer was always the same. I don't know, and I don't need to know. He believed the market is temporary, but businesses are real. If you invest in a company with a product people love, strong management, and sustainable growth, the market will eventually recognize its true worth. Throughout his career, Peter Lynch managed Fidelity's Magellan Fund with an average annual return of 29% for over a decade, an almost impossible feat. What set him apart was simple. He didn't try to call tops or bottoms. He didn't chase headlines or listen to TV experts. Instead, he spent his time reading financial reports, visiting stores, talking to employees, customers, and managers. He wanted to understand one thing. Is this company really creating value? Do customers come back for more? Does it have a competitive advantage others can't easily copy? For Lynch, investing meant buying a small piece of a business you'd be happy to own for the next 10 years. If you wouldn't hold it for 10 years, don't hold it for 10 minutes. He once shared a story from the early 1980s recession, when the Dow Jones was in freefall and investors were running for the exits. But instead of panicking, Lynch quietly bought more shares of the companies he believed in, especially retailers that were still full of customers, even as the news screamed doom and gloom. The result? When the market recovered, the Magellan Fund didn't just bounce back, it multiplied. Because Lynch understood one thing: the market may be wrong in the short term, but true value always wins in the long run. Now, ask yourself, have you ever missed a great investment because you were afraid the market looked bad? Or sold too early because the news sounded scary? Peter Lynch would say that's the most common mistake of all. Humans crave control over the future, but investing is a game of accepting what you can't control. You can't predict when the market will rise, but you can choose businesses that will survive and even thrive when it falls. You can't control crowd emotions, but you can go against them with logic and facts. Lynch believed investing isn't about prediction, it's about observation. Observing how the real world works, how consumers behave, how businesses adapt. If you can do that, you don't need to know when the market will move up or down, because you've already placed your trust where it belongs, in real value, not in stock prices. And that's how Peter Lynch beat Wall Street, not with prophecy, but with understanding. Part 5. How to spot a great stock. Peter Lynch had a philosophy that sounded almost too simple to be true. The great stocks are not hiding in analyst reports. They're right in front of your eyes. To him, the stock market wasn't a casino for speculators. It was a mirror reflecting real life. Lynch believed that if you go grocery shopping, drive a car, stream Netflix, or use an iPhone every day, you already have an investment edge. Wall Street will never have real-world experience. He once shared that one of his most successful investments came from a shopping trip with his wife. While Lynch was busy checking stock prices, his wife noticed that a store called Legs, owned by Hanes, was always packed with women lining up to buy a new type of pantyhose. Curious, Lynch dug deeper. He read the company's financials and found that Hanes had strong margins, a fast-selling product, efficient management, and little to no debt. He invested. A few years later, the stock had multiplied several times over. Lynch concluded, a smart consumer can become a smart investor if they're willing to observe. According to Lynch, great stocks don't need to be flashy or filled with buzzwords like AI, blockchain, or metaverse. They often come from businesses you already understand, the ones you know exactly how they make money. A grocery store that operates more efficiently than its competitors. A small company with a must-have product that keeps customers coming back. A local brand quietly expanding nationwide. Those opportunities aren't hidden in Wall Street boardrooms. They're sitting right in your neighborhood mall. Lynch once said, I don't have to know everything about technology to invest in it. I just need to understand how a company makes a profit and why customers need them. That's why he categorized stocks into 6 groups, from stalwarts to fast growers, and searched for hidden gems in each one. To Lynch, a great stock doesn't have to belong to a perfect company. It just needs a solid growth story, reasonable valuation, and visionary management behind it. Take the modern world, for example. An average American starts the day with Starbucks, pays with Apple Pay, shops on Amazon, and unwinds with Netflix at night. Each of those behaviors is a signal, an investment clue Peter Lynch would want you to notice. Because before Wall Street analysts discover a trend, consumers have already lived it millions of times. However, Lynch always reminded investors, invest in what you know, but make sure you truly know it. Understanding doesn't mean I like the product. It means you understand the business model, the profit margins, the risks, and why others haven't seen the opportunity yet. A great stock isn't a hot one. It's one that's undervalued compared to its true worth. He often compared investing to planting a tree. If you pick the right seed, Plant it in good soil and water it patiently. It will grow on its own. The problem, he said, is that most people keep digging up the seed every week to see if the roots are growing. Great stocks take time, sometimes 5, 10, even 20 years to show their real value. Lynch believed that patience is the most underrated superpower on Wall Street. In a world obsessed with chasing trends, Peter Lynch chose to move slow in order to go far. He didn't chase shooting stars. He looked for steady flames. Because, as he put it, a great stock doesn't have to amaze you every day, but after 10 years, it'll make you grateful you didn't sell it too soon.
Part 6. Discipline, Patience, and Faith in Reason. Peter Lynch once said, "Investing is not a game of intelligence, it's a test of emotions." During his 13 years managing the Magellan Fund, Lynch witnessed one of the strangest truths on Wall Street. The smartest people often made the least money. Not because they lacked knowledge, but because they lacked discipline and patience. He observed that most investors don't fail because they pick the wrong stocks. They fail because they can't handle how slow success really is. They buy when they're excited and sell when they're scared. They want to get rich quick, but the market only rewards those who are willing to get rich slowly. Lynch often compared the stock market to two kinds of people, a farmer and a gold digger. The farmer plants seeds, tends the soil, and waits patiently for harvest. The gold digger jumps from one pit to another, only to realize he never dug deep enough to find anything. A smart investor, Lynch said, must learn to live like the farmer. In the 1980s, when the market swung wildly and thousands panicked into selling, Lynch didn't flinch. He believed that chaos is the companion of the rational mind. While the crowd ran away, he quietly bought more shares of the companies he knew best. Businesses still making money, still growing, just temporarily hated by the market. The result? The Magellan Fund grew an average of 29% a year, crushing every competitor and becoming the most successful mutual fund in America. Lynch understood that in the short term, the market runs on emotion, but in the long term, it always returns to reason. A stock's price can drop 50%, but the real value of a business doesn't change because of a tweet or a nightly headline. Once you truly understand that, fear turns into opportunity. He often said, "No one can predict what the market will do in 6 months, but in 10 years, good companies will be worth more. That's a certainty." That belief became his competitive advantage, turning patience into power. While others chased new strategies, Lynch returned to the timeless ones. Understand the business, buy when the value is greater than the price, hold long enough for results to speak for themselves. Peter Lynch didn't just teach how to pick stocks. He taught how to choose your attitude. In investing, everything changes. Interest rates, trends, politics, technology. The only things you can truly control are your discipline and your reason. And Lynch believed that patience isn't about waiting. It's about keeping faith when everyone else has lost theirs. Imagine this. If you had invested $10,000 in the Magellan Fund when Lynch started and held it until he retired, you would have had over $280,000. Not because of luck, but because one man refused to panic when the market did. Lynch once concluded, "Emotion is the investor's worst enemy. Reason, discipline, and faith in time, those are your 3 best friends on the road to success." When Peter Lynch retired at the age of 46, he had achieved something very few people on Wall Street ever could. Not just extraordinary profits, but true clarity. He didn't leave because he ran out of ideas. He left because he understood a lesson that most people spend their whole lives chasing but never truly learn. Money is not the goal. It's the result of living by your principles. For 13 years, Lynch never tried to beat the market. What he really conquered was himself. Because in the world of investing, the ultimate winner isn't the smartest person in the room. It's the one who stays faithful to reason even when the whole world goes the other way. If there's one message One Up on Wall Street was meant to leave behind, it's this: you don't have to be a genius to succeed. You just have to observe a little closer, understand a little deeper, and believe a little stronger in the real value you see. Because the greatest investment opportunities aren't found in financial reports. They're found in your ability to stay calm when everyone else is losing control. If these ideas resonate with you, hit like to let me know you're still walking the path of rational investing. Subscribe so you won't miss more timeless financial wisdom that could change the way you see money. And share in the comments, what's the biggest lesson you've learned from Peter Lynch? Because who knows? Your answer might just be the spark that helps another investor out there find their way.